and today in this video I'm going to be talking to you about dividend stocks. Now, when you're investing, what's a very valuable asset to your stocks is a dividend. So basically, if companies are profitable or they have free cash flow, they're able to distribute dividends to shareholders. So, for example, some companies that pay dividends that I own, for example, include Broadcom, who pay quarterly, AbbVie, who pay quarterly, Main Street Capital, Victory Capital, Games Workshop, and Nexstar Media. Those are just some examples. Now, there are many companies that will pay a dividend, but when it comes to dividends, you do need to analyze, the company's ability to pay that dividend and sustain it. So essentially, what a lot of people do when they look for dividend stocks is they make the mistake of chasing the dividend yield. So what they'll do is they'll go to a stock screener, and basically this is what they'll do. They'll look for, so let me just get this stuff out. So they'll go to dividends, yield, and then they'll look for, yields over 10%, and then they'll look through the screener and go, okay, let's see. Okay, this one looks good. But the thing is, when you start to browse stocks that have a high dividend yield, you can see that in terms of the stock price, it's not very good, other than BWLP, which has done well in a 5-year period, and also maybe Grin. We can see here that, there's not really great performance for high yield dividend stocks. And like I said, I'm not even sure if this can even be bought because there's no news related to it, but chasing high yields, isn't the strategy really that you want to be going for. Now, don't get me wrong, sometimes it can work, but I wouldn't focus on dividend yield. What I would rather focus on are stocks with dividend growth, because it's good to hold on stocks for as long as possible, because you then benefit from the compounding growth effect of holding your stocks, earning interest upon interest. So if your stocks continually grow, that's the most beneficial scenario for you. So, a lot of stocks with high yields won't actually have high dividend growth. So if I actually go back to the screener, and we put dividend growth, let's say over 3%, you've only got 35 stocks now. And then if you want to go growth years, and we just put over 14, there's not enough. And then on top of that, we're looking for a high yield, some growth, and consistent growth, and we're not really finding high quality stocks. So this is why people need to not focus on the dividend yield, because the dividend yield is volatile. The dividend yield is literally dictated by the stock price movement. So if the stock price declines massively, then the dividend yield is going to go up. And that's kind of why a lot of these stocks on this list have dividend yields above 10%, because the stock price has experienced decline, so that the yield can get that high. What you need to actually look at is how the company's performing themselves, how much cash they've got on their financial statements, and what their dividend policy is, rather than just focusing on, oh, this company has a high yield, I'm going to get it. Don't do that. So basically, what I would suggest is, you know, instead go on these screeners. I made one called Dividend Growth. So look for companies that have had over 10% growth in the dividend each year. So like the compound annual growth rate, and then at least over 5 years of dividend growth. And then here you start to see some actual high quality companies. Microsoft fall into this, Broadcom, Visa, Costco. You know, you actually see some high quality companies now, not just any company. If you want to be a bit more high growth, you can go 20%. And then obviously there's going to be less options. Now, I do like to filter by the 10-year periods, and if we do so, it paints a different picture. So, essentially, let me show you an example of a good dividend growth stock. So Nexstar Media is a good dividend growth stock because not only do they actually have a decently high dividend yield, but if we go to dividends, it's growing over time, right? And that's what you want to see. Like the money that you have, like the amount of stocks you own, the dividend per share that you're getting is going to increase over time. So you're going to get more money from just holding the stock. And if you want a reflection of this, you can see in the dividend per share section, the growth has been very impressive. Now, if you want some context, I'm going to show you an example of a business development company called Gladstone Capital that have a high dividend yield, 9% almost. And then in terms of the stock price, there's not really much movement. If anything, they've gone down. But I'm going to show you a company with a high dividend yield, and then I'm going to compare them to Nexstar Media, which I showed you before, with the lower dividend yield. And I'm going to explain to you why Nexstar Media is the better investment despite having a lower yield. Right? So this site here called Portfolio Visualizer is very useful in comparing two different stocks, or also comparing a stock to an index, for example. So first of all, we're going to display the income. Now, what we're going to say as is initially we're going to start to invest with $10,000, and then we don't have any rebalancing. So we're going to get the ticker NXT, and then we're going to do GLAD, and then NXT is in portfolio 1 and GLAD is in portfolio 2. Now we're going to analyze them together, and then you can see on a compound growth rate basis, Nexstar Media does better, and they both pay dividends. But this is the most important thing here. So in terms of the portfolio growth, obviously Nexstar reigns supreme. $10,000 since 2004, which is in the past 20 years, would have turned into 160,000, whereas 10,000 of Gladstone would have turned into 29,000 in terms of the value of investment. Dividends are also reinvested as well, keeping that in mind. But now, if we start to look at the actual income that you get, you can see here Nexstar isn't paying dividends for a long time, but Glad is, and you can see it here. Then when Nexstar starts to pay dividends and they start to increase their dividend payout, you can see here that Nexstar eventually triumphs Gladstone Capital's dividend, and it almost doubles it. Even though Gladstone Capital has had a head start. If you want to reduce the years to, 2013, to just make it a little bit more recent, not just 20 years, you can see here, again, Gladstone Capital has a head start. Nexstar is starting to pay dividends now. But over time, even though, again, Gladstone Capital is higher, the growth of Nextar's dividend, which is in the blue bar, you can see eventually has it much higher than Gladstone Capital. So all of a sudden, you see that, Gladstone Capital having the higher yield seemingly doesn't matter, because in the long term, you'll see that the dividend growth by the company's own accord is going to matter much more. Another company as well that would, I believe, conform to this is Broadcom. So if you compare Broadcom, and again, Broadcom have a much lower yield than Nexstar Media as well. Broadcom's yield is only 1.59% compared to Gladstone Capital's 9%, which I'll show you just to remember, right? Much lower. But if we compare them again on the portfolio visualizer model, we can see here that, again, stock price wise, they both start with 10,000, but obviously Broadcom becomes a lot more valuable. 10,000 since 2013 turns into 550,000. Gladstone Capital turns into 37,000, both with reinvested dividends. Now let's look at the actual dividend payouts. Again, Broadcom, it starts out much lower than Gladstone Capital due to Gladstone Capital having a much higher yield. But then Broadcom increases their dividend over time, as you can see with the blue bar. And then you can see 2018, it's past it by double at least. And it's comfortably higher now, even though the yield was only 1.8%. So you can see what they call this is when you buy a company with a low dividend yield and they increase their dividend over time, your yield on cost increases over time because the company is increasing the dividend, and it becomes a better bargain when you hold the company for years and years and years, and they increase their dividend payout. At that point, the dividend yield doesn't really matter what's shown on the site, because that's just reflective of what the current stock price is. But if you compare it to your average stock price and they keep increasing the dividend, your dividend yield for your average price per share is going to seem higher than Gladstone Capital's in a way. So that's kind of the quality of it all. So again, this is why it's very important to look at the growth of the dividend in the companies that you're buying. And Broadcom are an example of a high growth company in the dividend. Now, a lot of their high growth kind of happened when they started out. They're a little bit more mature now, and their dividend growth isn't as aggressive. But if you want to look for good companies, try and find companies that start paying a dividend on a screener, monitor their financials, and see if they can maintain a high dividend growth rate. And if they can, that's a great opportunity to earn some passive income that's growing over time. So keep that in mind. So I hope that helped. And yeah, always try and look for companies with high dividend growth. Do not chase high dividend yield.